Good afternoon, everyone, and welcome to the analysts meet for Bank of Baroda's financial results for the quarter and half year ended 30th September 2023. Thank you all for joining us. We have with us Shri Devdutt Chand, the Managing Director and CEO of Bank of Baroda, and he's joined by the bank's executive directors and the CFO. We have a short presentation followed by brief opening remarks by Mr. Chand, and then the Q&A session. And sir, over to you.
Yes, good afternoon all. Before Ian start, let me introduce the entire team. I'm D. Chand, the MD and CEO. Along with me, Mr. A.K. Khurana, Ajay K. Khurana. He looks after the entire MSME vertical along with a lot of platform functions. Then we have Mr. Jaideep Dattara. He's the Executive Director looking after the retail part of the entire book, both on the retail assets and liability. Then we have Mr. Lalit Tyagi. He's Executive Director. He's looking after the entirely the corporate book of the bank along with the international banking and treasury. And let me again pleasure to introduce for the first time Mr. Lal Singh, who joined as Executive Director. And he's looking after most of the platform function, including the IT and the HR. And we have the CFO, Mr. Ian D'Souza, to whom you know since long. So over to you, Ian.
Thank you, sir.
Yeah.
Can we have the PPT, please? Can we move ahead? Good afternoon, everyone. So to take you through highlights of our results. During the quarter, our global advances grew 17%, supported by strong growth in domestic at 16.5% and international at 21%. Within our domestic advances, retail advances grew 22%, agri grew 13%, MSME continued the trend of growing 12 to 13%, and corporate advances after a long time showed strong growth at 16.5%. In terms of our diversified retail loan book, our home loan book is growing at 16%, education and auto loans are growing at 18 and 21% respectively. Personal loan growth has been 67%, but year on out, this growth may moderate a bit. Next, please. In terms of our liabilities, our total deposits grew almost 15%. Our CASA growth was a little muted at 4.5% year on year. Domestic term deposits grew at 17.7%. A notable fact here is term deposits on the retail side have shown sequential growth, and the growth in bulk deposits from double digits last quarter sequentially has moderated down to single digits. In terms of our CD ratio, our domestic CD ratio is more or less in line with the CD ratio we printed in last quarter, though it is about 450 bps higher than a year ago. Moving ahead, please. NII for the half year has grown close to 15% year on year. Operating profit strongly printed at 50% higher year on year. Profit after tax is also around 52% higher. ROA is a metric that we've been tracking on ourselves on, and after many quarters we have been at 1% plus, and this half year is no exception. We had 1.12% ROA as compared to an ROA of 0.84 for the same period in the previous financial year. Next, please. The same metrics, if you look at from a quarterly perspective, operating profit is up 33% on a quarter year ago. Profit after tax almost close to 30%, and ROA is further strengthened. It was 1.01 the same quarter a year ago and 1.14 now. Moving ahead. In terms of deposit costs, we have seen some spike given the continuing liquidity scenario. We had expected the scenario to start to abate, but it looks like given the signals from the Fed and the regulators that this liquidity scenario will continue and elevated rates will continue for a while. So we've seen deposit costs go up quarter on quarter, but if you see H1 to H1, we have maintained the NIM. But however, given the steep deposit hike and the advances yields being in line with the previous quarter, we have seen some NIM compression. and NIM has, on a quarterly basis, has come down by around 20 basis points. Please go ahead. In terms of asset quality, you will see that the asset quality has strengthened. Almost 200 bips have been shaved off our GNPA as compared to a year ago position. NNPA remains benign at 0.76, almost 2 basis points sequentially down. Provision coverage ratio, including TW accounts, remains high at 93%. Our slippage ratio looks elevated at 1.81 as compared to the previous quarter sequentially. But however, this includes the slippage of a large aviation account of almost 1,773 crores. If that were to be excluded, the slippage on a BU aspect would be just 1.08, which is just about 2 bips higher than the slippage in the previous quarter and within the range of guidance that we had given for slippage. Similarly, if we look at the cost of credit, it is a bit elevated at 0.92. But however, we'd like to call out on the non-guaranteed portion of the aviation account, we have provided 100%. So we've taken almost 534 crores of extra provision on that account. We've also taken prudential provision to maintain our NNPA and coverage ratios. So put together, that's almost 1,000 crores of provision that has been taken to strengthen the balance sheet. If that were excluded, our credit cost would be around 0.52. That is in line with our adjusted credit cost for the previous quarter of 0.44. This 0.52 would also include provision of 639 crores for the aviation account that slipped. Please go ahead. In terms of our collection efficiency, that continues to be strong at close to 99%. The SMA 1 and 2 CRILIC above 5 crores is at 0.22%, indicating that there's no large account that's on the horizon for slippage. Please go ahead. Our capital position remains strong. Our capital position as compared to a year ago is about 5 basis points stronger. In terms of CET1, we are at 11.57%. But as you probably know, these numbers don't include the profit for the half year. If the profit for the half year was to be included ex-dividend, our CET1 would have been at 12.47 and our CRAR would have been at 16.20, which is very close to the number we ended the previous financial year at, which was 16.24. That brings us to the end of my opening remarks. Over back to you, Firoza.
Thanks, Ian. Shanta, can I request you to give your opening remarks, please?
Yeah, once again, good afternoon to all. And the current quarter performance is consistent in terms of the performance we had for the earlier quarter. And also the last full financial year where the bank had a very healthy profit of 14,100 crore. So most part of the presentation we have covered the financial for this quarter, but let me make a couple of comments with regard to the overall financial. If you look at our loan growth book, the loan grew by 3.4% quarter to quarter and 17% YY, with a retail growth of 22.2% YY and 5.2% sequentially. We continue to maintain our guidance of growing above the industry by 1 to 2% on the overall loan book. At the same time, on the retail side, we need to grow 3 to 4% higher than the industry average on the retail book. We continue to maintain that the overall loan growth would be 14 to 16%. And last time also I guided the market that will be growing at 15%. And this quarter it has been 17%. With the guidance of 14 to 16% for the overall loan book, the corporate would continue to grow at 12 to 13%. And the retail would grow 20 to 22%, and international would be around the bank's growth, that is 15%. That is what the guidance for going forward. Our loan book strategy has been to increase our retail business aggressively. Currently, the retail is around 27% on the retail book, and we intend to take it to 35% in next 2 to 3 years' time. And the corporate book would come down to 35%. In terms of the NII of the bank, already you have seen that the YOY growth is 6.5%, backed by a strong loan book growth of 17%, despite bit of margin compression in this quarter that we have seen. On the NIM outlook, although on a H1 scale we maintain the H1 of last year on the NIM, but there is a NIM compression, and the outlook of the guidance that we are going to give it now is around 3.15% plus minus 5 BPS going forward. We had guided the market earlier that we'll have a full year NIM of 3.3%. As against that, the guidance is now 3.15% with a plus minus 5 BPS around the guidance number. On the cost to income, we are again guiding the market to be around 45%. We have not added much cost with regard to the branches or manpower in this quarter. The good part of this quarter, you would have seen the numbers that there is a strong fee-based income and also non-interest income. It's precisely last time we also outlined a strategic initiative in terms of the year of fees and flows. We are seeing significant traction on this concept. We have implemented a couple of, particularly for large corporate and mid corporate, the concept of share of wallet, account planning, and relationship management. We're trying to have the culture of sales in branches, and we're driving the bank from engagement or relationship banking to drive the cross sell. In terms of profitability, it was a healthy profit that you have seen of a net profit of 4253 crore for this quarter. And this is consistently the third quarter we are posting in excess of 4,000 crore. The H1 profitability grew by 52%. In terms of the last year full profit by Q2, half year of current financial year, we have almost achieved 60% of last year full year profit. The good part is that the ROA has been more than 1% consistently for last 1 year. And our endeavor also to maintain this ROA guidance of more than 1% going forward. On the asset quality, NNPA improved to less than 0.76%, with GNPA improving by 199 BPS on YOY basis. We have dedicated collection vertical for RAM, which is unique in the entire PSB space. Deposit has been growing in line with the industry. We can expect going forward a deposit growth of 12 to 13%. We have calibrated the retail term deposit and wholesale deposit. We have given the breakup this time, and you can see the wholesale growth in this quarter is around 3.4% sequentially, which continue to be 11 to 15% for last many quarters from now. So considering the overall scenario, we are trying to contain the growth of wholesale deposit. Couple of things which are very important. First time in the entire festival campaign, which is normally during the festival time, we started a campaign with regard to Bop Ke Sang Tehwar Ki Umang. And it is not only on the campaign on the asset side, but also on the liability side. And there are 5 new products that we introduce on the liability precisely to give boost up to the CASA, particularly the saving. Bob Light, Bob Grow, Bob Parivar Family Account, and Bob SDP account, and Baroda NRI Pack account. We are seeing significant traction on all this deposit. And I feel that this campaign going forward would push up my CASA further, at the same time allow me to contain the bulk deposit and consequently improve or optimize on the NIM side. Thank you very much. We'll go for the question and answer now.
We now open the floor for question and answer. I request everybody who has to ask questions to raise their hand. Please restrict yourself to 2 questions at a time so that everybody gets a chance to ask. We'll wait for 5 seconds for the lineup to populate. The first question is from Jai Mundra. Please unmute yourself and ask the question.
Yeah, hi, good afternoon, sir. First question, sir, is on your international slippages. So that has also increased in this quarter at around 500 crore plus. So A, if you can provide some details as to where that has coming from. And, could this be a bit of a recurring nature?
So good afternoon, Jay. It's one account which slipped during this quarter, and this is a one account where it's fully asset-based. So it's typically because of some liquidity issue, the account has slipped, and we are hopeful that maybe coming quarters, the asset is a good quality asset and it will be updated also.
And which segment would this account be, sir? I mean, which sector?
It is on the typically the real estate sector.
Okay. Sure. And secondly, sir, you have revised your NIM guidance. Is this more, we can see that the yields have started to flatten, whereas cost of deposit is still rising. So would that trend should sustain that yield, barring the loan mix barring the loan mix improvement, the yields would be more or less flattish and the cost of deposit could keep rising. Is that the way to look at it?
A couple of things happened. Last time we gave a guidance of 3.3% on a backdrop where there was an outlook at that time that the rate of interest would reverse in Q3 or Q4. But since then, the outlook has completely changed. And currently, if you look globally also here in India, the outlook is higher going to stay for longer. So on that particular outlook, there was a cost impact therein. But if you clearly see, the cost impact mainly came out of the term deposit. So if you look at the current numbers that we have declared, we are going to have a containment of the on the wholesale deposit and constraint cost on that. So now, if you look at the outstanding, the entire cost impact has come in this quarter. So going forward, I don't expect any further cost impact on the cost of deposit because of the higher rate in the term deposit. At the same time, as a strategy, we have pushed aggressively with regard to the saving and CASA. Saving, I have already announced a couple of schemes where there is traction going on. And on the CASA front also, there is a relationship manager again. On the entire retail liability piece, we have changed the structure in terms of how to deliver this product. So we implemented a relationship management concept therein. So I am thinking that going forward, the CASA would grow slightly better than what we are looking at currently. At the same time, clearly we'll contain the wholesale deposit. And I don't see any impact of further rising on the cost of deposit going forward. And at the same time, maintaining our asset quality and the return out of the asset, and then possibly the NIM guidance that we are doing is going to be maintained.
Understood, sir. And sir, just if I can ask, this account which has slipped in the overseas, this is from which country? I mean, because we have grown overseas book at a rapid pace in the last year. So just wanted to check, if there is any country which you mentioned the real estate. So if you can also share the country where this had slipped.
It is in the Middle East. It is not in the US market or any other market. It is in the Middle East.
Right. So, okay. And this is no India linkages, right? The group would be Middle East based only, or this is like, India based or having some JV kind of a thing.
I don't think much of India exposure they are in, but then it's basically a UAE entity. Pranav, have anything you want to add on this?
No, it's a company having business everywhere, but they're based in there only, not here.
Okay. Thank you, sir. I will come back in the queue.
Thank you.
The next question is from MD Mahesh from Kotak Securities. The bank has reported a strong income in recovery from write-off. How should one look at the contribution in second half of FY24?
Okay, Pranav, can you take this question?
Yeah, few one-offs were there during this quarter, but maybe little bit here and there. But we are expecting in next 2 quarters also little less than this in write-off accounts.
The next question is from Rikin Shah of IFL. Would you please elaborate on what is driving the strength in fee income growth? And is it going to be recurring in nature?
Yeah, it's a very good. This typically the strategy that we last time said that the bank keenly focused on a initiative called fees and flows. So the aspect of fees that we have seen this year is particularly on the large corporate and the mid corporate, we implemented the concept of relationship manager. And the idea of relationship manager is to measure the SOW, the share of wallet of all these accounts, and try to leverage the main relationship for multiple other engagement, and that's seeing now good traction there. So it's something strategic, it's something structural now, and we expect going forward the growth would continue to be there in this particular front.
Thank you. The next question is from Concall from Citi. Please unmute yourself and ask the question.
Yeah, hi sir. So particularly on recoveries from write-off. So the only question was when we look at it, significantly higher amount this quarter. So was there any particular maybe particular account which is leading to that? So I think MB also asked that question, but didn't get the reply in terms of what has led to almost like 1,230 odd crores kind of recovery. And in terms of the outlook, should we expect that to normalize to less than 500 odd crores kind of a number, or we should see this kind of trend because that has supported the earnings this quarter in particular?
Yeah, Pranav sir, can you take it and then CFO can join them?
See, some 400 to 500 crores was one-off in this quarter. That is one ILF account was there. But what we see is in next 2 quarters also there are a few accounts lined up. So we are expecting almost whatever we have recovered in half year overall. For 10% here and there, we are expecting this.
I agree with Khuranaji's views. So we should see around 2,000 crore level for the H2 of financial year 24. Similar to H1.
So that kind of a recovery will continue in H2 as well.
Yes.
Okay. Great. Yeah. Thank you.
The next question is from Sushil Choksey. Please unmute yourself and ask the question.
Congratulations to Bob team for excellent result. So my first question is, our new mantra is to grow more on retail. What are the new initiatives which you would take to sustain a growth with a good margin on a year-to-year basis? And does bank view that every bank is looking at retail as a priority sector in terms of growth engine? So where housing loan is concerned, auto loan is concerned, education loan is concerned, competition may not give you that kind of a healthy margin which bank has initiated so far. So what would be the difference which Bob would do it, if you can publicly speak about it, which would make your product more viable compared to competition?
No, that's fair. Thanks for the question. On the retail asset side, consistently we are growing higher than the market. I mean, that is what, it's not 1 quarter, it has been almost now 7-8 quarters where our growth is higher than the industry average. The second aspect, very, very important. Recently, in terms of structure of all these branches, we have segmented branches in the entire bank now in terms of retail-oriented branches, priority sector-oriented branches, corporate branches. And all these branches, as I said also initially, there is a clear sales focus now. And the sales focus in terms of implementing some kind of a relationship management concept over there, RM should be there now in all these branches more than what it used to be earlier. One. The second is clearly in terms of generating bulk leads also, one separate section looking into bulk leads in all these segments, like if I'm talking about housing loan or a car loan or a education loan or personal loan, we are more going for bulk also. And thirdly, if you look at Bank of Baroda in terms of the digital delivery, particularly I'm talking about the digital lending platform. So the delivery in terms of all these loans are, I mean, very competitive vis-a-vis the market. So I'm typically referring the TAT in terms of the delivery. So already we do have bit of delta over the market average. Best Bank can be growing much higher than me. I know the bank that we are talking about. But in terms of market average, I am slightly growing above the market average. And that's already the USP as far as Bank of Baroda is concerned. And I think the new initiative that we started to make the organization more sales focused and more of a digital orientation in terms of process delivery. One thing also last quarter we announced that we have now the regional processing centers for retail asset sanction at the regional level, which earlier used to be at a centralized level. So there is a bit of decentralization therein, but at the same time, we have ensured that the underwriting standards are clearly maintained in those centers. So a lot of churn also happening within the bank to drive it further. And I think the market is growing also across this segment, across all banks. And since we have a guidance of growing slightly higher than the market, I believe we are going to sustain this going forward. Anything, Jaideep, you want to supplement to this?
No, I think you have covered beautifully. Just to add one more thing that on the asset side, we are also giving due focus to various channels, even within a product. For example, within housing loan also, we are looking at different types of channels through which we onboard customers and give more loans, etc. So there's a builder channel, the DSA channel, the aggregator channel, the branch channel. So all of these are now given proper focus, and teams have been created, which again would help us do much better business. And also that guidance of doing better than the industry in terms of retail, being 4 to 5% above industry, that continues. And the focus on relationship at the branch level, which has been a recently introduced concept and which MD was talking about, that again would help us, even though the margins may be small, maybe competitive in terms of the competition also giving very fine rates, etc. But at the same time, these are loans which have a lifetime value, and customers are there for longer tenure. We need to build the relationship, and through cross-sell, etc., there is a lot of value that we can generate. So that relationship management also helps us in that direction.
Basically, you are saying that formalization of economy and Indian economy going to 5 trillion would enhance the potential on a consumer demand far larger than where we stand today.
Very fair, very fair.
Yeah. Second thing, sir, based on current Fed outlook, which has emerged post Wednesday's meeting, Chancellor, you are expert at Treasury. Don't you see what was the turmoil going into the next second half? And based on RBI Governor's speech at Business Standard event, and the way world has transformed between Wednesday and Friday for yields are concerned, don't you see second half being a little different compared to what the fear in the street is?
See, anyway, being a market person also, I believe we normally anticipate the market, not predict the market. So in that way, my current anticipation is that the levels have already picked out because market moves ahead of most of this event. In terms of the stance part, everything, I think the yield is a lead indicator to give a direction to the market. So in that way, particularly from the treasury side, I do not expect yield to go up further. Already it is finding a near peak level. That is what my sense is. Market has resilience. We have seen a different scenario also, particularly our bond market is much more resilient, much more robust, not that volatile like any other market globally is. So in that way, I find not much of what you can say any adverse impact come out of the yield movement in the next quarter or going to be the next half year. We are broadly at this level discounted most of the factor, at least for near future, subject any geopolitical issue not disrupting the market globally, also Indian market. Otherwise, fairly balanced level of the 10-year yield, and I don't think in terms of rate of interest anything going to be much of change in coming quarters. Rather, in case we get a fair lead with regard to the rate reversal, then possibly the levels will start discounting that and start moving in a positive direction.
Thank you, sir. The next question is from Abhishek Murarka from HSBC. What is the breakup of your loans by MCLR, EBLR, and fixed rate? How much of MCLR linked loans are likely to reprice in the second half of financial year? can that lead to increase in your yield specifically?
I believe, Ian, you can correct me. The MCLR link is almost around 52% now.
Yes.
That's
It's proportion wise.
Yeah. There is bit of book still left to be repriced at the MCLR, but then going by the cost matrix, I believe there is still upside for MCLR going, because normally MCLR moving with a lag vis-a-vis the cost of deposit. So still there is upside. So rather than the reprice book giving me a better ROA, I believe possibly the level of MCLR going to give me a higher yield on advances. So that's the sense currently in terms of reprice book. There is upside, but then that may not be significant to offset the cost of deposit, which we have seen this quarter. But I believe the level of MCLR need to realign, and then possibly can give bit of more further income, pushing up the yield further. Is that Ian, anything you want to supplement on this?
Yes. So there's a very small proportion now, less than 30%, which is probably up for repricing. The bulk of the book has already repriced, and it's the cost pressure that has to be transmitted to the MCLR.
Thank you, sir. The next question is from Prakhar Agarwal of Elara Capital. His questions are three parts. What explains strong growth in international deposits? Second question, can you please explain the product differentiation on new products that you mentioned? Is it rate or something else? And third question, given that we have tweaked our NIM guidance, how you look at ROA guidance now?
Okay, so let me address the last first. In terms of NIM and ROA, as far as the bank is concerned, now we are putting NIM and ROA on the same platform. Rather, if you want me, I'll repeat rather ROA and NIM combination. That is what the strategy of the bank is going forward. We continue to hold ROA guidance in excess of 1, because NIM is purely driven by the interest expenses and the earn, whereas ROA is driven by the lot of the fee and non-interest income that we are generating based on our concept of fees and flows. So apart from the normal income which is captured in the NIM, I believe my fee income and non-interest income, the growth is going to be significant in coming quarters. And in that sense, slightly because of the cost pressure that we have seen this quarter, we have revised the NIM guidance. But ROA continue to be in excess of 1. Rather, the last quarter ROA is at 1.14, which is a very healthy one. Not only for us, but entire industry also. So we'll continue to have ROA in excess of 1. At the same time, try to optimize on the NIM based on the evolving scenario which the market would offer to us. The second, with regard to the new products that we talked about, this is the pricing. There is no differentiation therein, but the differentiation is more on the offerings. The offerings are like the first product of Bob Light. We talked about a zero balance. So in terms we are slightly looking at a growth with a zero balance, but then with certain balances, then a lot of advantage would accrue to the customer in case they maintain the balance. So these are all on the services and offering rather than the pricing. The pricing continue to be the same like a general saving product in that particular segment. Jaideep, anything you want to add on this, on the product side?
Yeah, so just to add on that this time the focus has been on bringing out a very comprehensive offering in the for a festival campaign, not just focusing on the asset side but also on the liability side. And in the liability side, there's a range of products that has been introduced, not just one or two products, addressing different segments of customers. So as MD was mentioning on the Bob Light, this is again a sort of a requirement that many customers themselves responded in a survey that they don't want any minimum balance requirements, etc. But at the same time, they want offers and very attractive offers, etc. on various transactions, etc. that they do. So this account is basically a zero balance with no minimum balance requirements, etc. But at the same time, very high on offers. And if people have to sort of take advantage of the offers, they automatically end up keeping balances. So which also helps the banks. There's a Bob Bro account which is targeted to the student population. There is a Parivar concept account. There's a Parivar concept which has been introduced, which is like a family plan of in a telecom in the normal phone accounts that we have this concept of a family plan. So similarly here we have introduced a family plan for a group of accounts belonging to the same family, where there's no individual balance requirements for each individual family member, but for the family as a whole, if they meet some total balance requirements, then they get advantages in terms of various benefits, etc. from the bank. So then there's a repositioning of our RD product as a SDP, or a systematic deposit plan, which is both possible for a fixed amount or also of a flexible amount. So a lot of product features and innovations have been brought about, which are not on the pricing side, but in terms of giving what the customer wants and addressing some of the customer needs. And I think that would be much more helpful for the bank as a part of its CASA strategy also, in the CASA and the deposit build-up, plus also addressing the needs of customers.
So addressing your first point with regard to the international deposit growth, typically in international market, we raise the deposit based on the asset growth. But this quarter, the growth in the deposit is slightly higher than the asset, because to fund the asset, point one, and secondly to make some interbank operation therein, because that gives bit of differential rate of interest. And some part of global market on the investment side also looking very, very attractive. So this typically a mix of the asset strategy, investment strategy, and interbank operation for the matter. But broadly, we guided the market both in terms of asset and liability international book. There is a moderation that happened vis-a-vis Q2 over Q1, and going forward, it would converge to the domestic growth. So maybe in Q3 and Q4, the numbers would almost converge to the domestic growth, excluding the price, the USD INR differential, it would normalize to the domestic growth.
The next question is from Manish Shukla from Axis Capital. Please unmute yourself and ask the question.
Yeah, good afternoon and thank you for the opportunity. So for the previous 3 quarters, you had a very decent growth in bulk or short-term deposits. Now in Q2, obviously you've not grown, but these past deposits will come up for repricing over the next 2 quarters. So what kind of cost of funds impact is likely to have?
No, that's a fair question. If you look at current quarter, the growth in bulk has been much lower as compared to earlier quarters. And this is a conscious strategy to grow slightly lower on that. But you are right, there is going to be a repricing of all these deposits we have mobilized in earlier quarters. But if you look at the retail term deposit also, the growth is now higher as compared to earlier quarters. So my first objective would be to reprice a portion of deposit, not in the bulk segment, but in the segment of the retail or on the CASA segment, because we are pushing CASA aggressively now. At the same time, on the level of bulk deposit cost, I think now levels are picking out now. Actually, I don't think much of further cost push or anything coming on the bulk segment. Rather, I would think going forward, subject to the liquidity being consistent, then there can be a moderation also possible. In that case, I'll get the repricing benefit. The third aspect, which is very important for a segment bulk like that, thinking through maybe in Q1 of the next financial year or Q2 of next financial year, if there is a rate reversal coming, then one of the biggest beneficiary of that will be Bank of Baroda, because then we have this bulk segment going to get repriced in those quarters. So it's a combination of multiple things, but then on the cost side, I'm not expecting or not anticipating any significant change vis-a-vis the current cost on the bulk deposit.
Sure. My next question is, post the RBI restrictions related to the Bob World app, what are the steps that you have taken within the bank? And can it have any near or medium-term business impact?
No, that we have clarified. If you see one of the notes to account, this amply being clarified by the auditor also. So a scenario like this where there are basically 2 impacts. One is a service, another is a account opening. If you look at my account opening through Bob World, the percentage was very, very less than 3% or less than 2.5% there. So it's not going to impact me. And normally a scenario wherein for a new customer I'm onboarding into a platform, then there are multiple channels where these channels go up significantly high. So if you look at my deposit that we, let's say 10th October is the date, and today, my all segment, the deposits have been much higher as compared to the level at that time. So business is as usual for us. We don't see any impact because again, yes, there are certain services we are unable to provide to new customer, but then they have multiple channels available to do their transaction. So in that way, the impact is minimized or impact is very less. So going forward, again, if you go to the main part of it, there is a regulatory action and there is a compliance with the bank on the regulatory action. So a lot of action we have already done in terms of compliance, and hopeful that the ban is revoked at the earliest on the matter. But in terms of business, the business is as usual. We have strengthened channels to compensate any loss that is occurring out of banning of new customer. Existing customer are having similar service. Rather, the number of financial transaction and non-financial transaction through all digital platform have significantly gone up during this time. So my other channels are working very strongly at this point of time.
Okay. So the last question is on fees. I mean, fees have been a very big growth engine, as you mentioned. But if I see over the last 1 year, 6 months, the rating profile of your corporate book has gone up. And you're saying that fees is coming from the corporate channel. So can you give a specific example in terms of either the type of the product or the type of the corporates which are driving these fees? Because typically what we understand is making fees from large corporate is a difficult task. And you seem to be doing it. So what is it that is working for you?
See, generally what happens, there are a couple of things that we implemented. You are precisely right on that. So my asset quality in terms of earlier also multiple times we have said on the corporate book, underwriting is a very key aspect of Bank of Baroda in terms of underwriting standard. At the same time, when we implemented the SOW concept or relationship management concept, we are aggressively pushing for the cash management business now. And I'll just give you a data point without actually sharing the data. The number of customers we had onboarded in the last 6 months is almost equal to the number of customers we onboarded for last many years. So a significant push is on the CMS. The moment you push the cash management service, you have a lot of flows being captured and there are charges therein. So this pushed up significantly. Thirdly, when you do all this processing fee and all, let's say a year back or a year and a half back, all these customers, the base pricing used to be a particular level, but then all these charges also, because liquidity was abundant, was very competitive and the charges also low. Now we're revisiting all those charges in terms of what is that actually you need to charge in the current market. So even if your base price may not go up significantly high, but at the same time, the charges are being reviewed and being captured. So in that way, there is a good traction therein. Tegesa, anything you want to add on this further?
In fact, you have covered also. All I can say that right now we are able to capture more share of the flows of the customer, and we have been able to engage them a bit more, and that's where the income is getting added up.
Thank you, sir. The next question is from Rakesh Kumar of JMK. Please unmute yourself and ask the question.
Yeah, hi. Thanks, sir. So couple of questions I have. So firstly, with respect to, term deposit being in the bucket of more than 2 years, so could you quantify the proportion of that term deposit sitting in more than 2 years bucket?
See, we'll provide you the data exactly, but then if you look at the duration of my term deposit portfolio, it is, I'm excluding the behavioral pattern of getting rolled over again and again, but it is almost like 1 year, 2 months kind of a number. That talks about deposit below 1 year and deposit above 1 year. But exactly, Jan, you have the data you can share, otherwise you can share it to you.
So we'll share it offline, sir.
Yeah, that's fine.
Because, see, the reference to the question is that RBI says that, in the term deposit more than 2 years, in the fresh deposit, transmission is only around 130 bips as compared to repo rate rise of around 250 bips. So I think there is a, quite, large amount of repricing is yet to be done on the term deposit side for the industry and for you also, I think. So wanted a clarification on that front. But anyway, if we can help with that data later on, that would be helpful.
Yeah. Actually, I just respond to that. It's fair. Actually, most of the deposit, particularly on the term segment, the preference is on the 1 year, around 1 year. I mean, that's the normal preference. People do have slightly a tendency to put long term, then they put it in the higher buckets. In 2 to 3 year segment, let me say that recently we are offering the peak rate in that particular bucket now, and that revision we have made it just 2 months back, I believe. So there is one segment where again we are trying to have bit of more deposit because that adds to my liquidity stability, right? So in that way, there is a clear strategy as far as we are concerned, but the fair data will provide you.
Sure, sir. Secondly, sir, on this NPA, what we have sold this quarter, so there is a reversal of provision of close to around 150-160 crore in this quarter. Is it correct?
No, that's typically because of that classification. Ian, can you just clarify on that?
Yes, in terms of slippage, are you asking about?
No, the provision.
NPA sold to ARC. Yes. So there is a reversal of provision of 160 crore as per the notes to accounts.
Yeah, this is correct.
This
is correct. This figure is correct. Yes.
And secondly, sir, there is another reversal of provision of around 82 crore as per the notes to accounts number 17. So if you can just reconfirm if that is also correct.
Otherwise you will provide him offline then. That's right.
We'll provide this offline.
Yeah. Sure, sir. There is another, we saw that for certain accounts we are holding around.
Firoza, I think we'll take your questions offline. You can contact me because I think we have one more panelist who wants to ask a question.
Yeah, just the last question, sir. Just a clarification again on the notes to accounts. So we had close to around 1100 crore provision on certain accounts, and now that provision has come down to 800 crore, 810 crore. So
correct.
What has happened?
I'll take that question.
Yes.
This included provision on the aviation account. Now that account has slipped, and that provision has now shifted to NPA provision. It's no longer a standard account. So we've released that provision and the provision has been made in the NPA provisions.
Okay, so can we go next, Firoza?
The last question for the evening is from Chintan Shah of ICICI Securities. Please unmute yourself and ask the question.
Yeah, thank you for the opportunity. So just two questions from my end. Firstly, on the domestic LDR. So, sir, our currently CD ratio is around 78% on the domestic side. So, is there any scope for taking it further up from here, or would it stabilize at these levels? Yeah, that is the first question.
So, obviously, we'd like to, because for a NIM equity measure, we'd like to have a higher CD. But then again, all would depend upon the kind of book growth that we are looking at all these segments. So, if would you like to improve? So, answer is yes, definitely would like to have a higher CD.
But so, is there any upper ceiling or something? Like, are you looking at?
No, there is no upper ceiling. It's only optimizing the CD. That is how we look at. Because CD is not the only parameter that we look into. The combination of many parameters we evaluate CD. So, there is no upper ceiling, but then obviously we try to optimize on the CD.
Sure. And so secondly, on the slippages, so we had one large aviation account and one international book. So there would be some interest reversal also from these slippages. So if you could just quantify that amount, and what would be the margins, which is 3.07, what would be that if those two slippages were not there? How much would that be?
Pranasap or Ian, can you?
We'll just come back to you. You can ask me this question separately. But these accounts were in stress for quite some time. So it should not be a big amount, but we'll come back to you on this.
Sure. That's it from my side. Thank you.
Rosa, back to you.
Thank you, everyone. That's the last question we'll be able to take today. Ian, can I request you to give the vote of thanks, please?
So thank you, everyone for joining us on a Saturday afternoon. And as always, it's been a pleasure to have you with us. Look forward to seeing you the next time around. Thank you so much.
Thank you very much. Thank all of you. Thank you.
Thank you.
Thank you, everyone.